All right, we are right at the top of the hour, so we are going to go ahead and get started. We've got a packed hour of information for you, updates on SmartMix, an economic outlook with Tom Fox. So a lot of information to go over today, so we are going to go ahead and get started. I know some people will continue to be rolling in here, and we will allow that to happen, no problem, but we are going to go ahead and get started. So if you are a client on the call today, I'd like to extend a very special welcome to you. Thank you for taking a little bit of time out of your busy schedule to be on this call with us here today. If you're watching this in the replay later, the recording, thank you as well for taking some time to go through this. Feel free to fast forward through the parts that you want to pay special attention to on this important update. If you are new here, my name is Eric Hagen. I'm a small business owner. I'm president. I'm wealth manager with Capital Consulting Group. CCG for short consists of myself, Chief Investment Officer Tom Fox, who you will be hearing from a little bit later this morning, financial advisors Dan Oshman and Rana Grant, new financial advisor, Ryan Dewey. So for those of you who have been working with Ryan, as he's been in more of a support role, next time you see him around the office or you have a chance to send him an email or otherwise, please do congratulate him. He recently completed all of his licensing exams, went through rep review, and he is a registered rep financial advisor with Next Financial Group. He will continue to be in the support role as you've come to know him, for those of you existing clients. But this is the beginning of his journey to becoming a financial advisor. So please, again, congratulate him as you have the opportunity to do so. And then, of course, wrapping up the team, Marilyn Westmark. Together, we serve and steward long-term relationships with our clients, and we work only for our clients. Our broker-dealer is Next Financial Group, part of the Atria network of companies. We do all of our trading on the InvestNet platform, and we hold all of our client accounts at either Pershing, a Bank of New York Mellon company, or TD Ameritrade. We are an independent firm. We are not owned by a bank, by an insurance company, or by some large financial institution. We're located in Eden Prairie, Minnesota. We serve people all over Minnesota, and with our 100% virtual advisor capabilities, we serve people all over the country as well. We can help you see your entire financial situation, both today as well as every year into the future, through our personal wealth planning services. To learn more about this, you can go to clearfinancialfuture.com and watch the 2-minute video. And we also give our clients' life savings the attention it deserves with our SmartMix portfolio solution. SmartMix is our personalized portfolio solution for individual investors. All right, so with that, our agenda today is to review what SmartMix is, how it works. We're going to take a look at current holdings. We'll take a look at performance. Tom is going to join us and talk about the economy, what's happening, what the outlook is, and then I'll spend a little bit of time talking about how to determine your unique SmartMix. So what is SmartMix? Well, SmartMix is our process. It's not a product. SmartMix is our personalized approach for helping our clients get and stay invested right. Everyone is unique. What's right for you is different than what's right for others. If you have an IRA, a Roth IRA, an old 401k, a regular taxable account, maybe a jointly owned account with your spouse, maybe you have a trust account, SmartMix is our process for helping get each of those different types of accounts invested right, given your unique situation, goals, objectives, time horizon, risk tolerance, income, liquidity needs, growth objectives, and more. It's kind of like a blueprint when you're building a new home. SmartMix is a process, a lot like the process that everyone uses to build a home. Not all homes look the same, but everyone develops a blueprint first. SmartMix is our process. In the same way that there's a blueprint for a young couple building a house who's just starting out, or maybe a busy family in the thick of life, or for a retired couple looking to downsize, or I like to say right size, there is a SmartMix for many different situations. So whether you are just starting out, you need to grow your savings, or you've been saving for decades and you need to live on your savings, or maybe you just received an inheritance and you need to know how to deploy that newly obtained wealth. There is a SmartMix for many different situations. SmartMix is the next step in the evolution of investing. The same way that dial phones replaced rotary phones when they died, and cell phones replaced dial phones when they died, or how CD players replaced cassette tapes when they died, and iPods replaced CDs when they died. Direct indexing, which is what SmartMix is, direct indexing is the next step in the evolution of investing. What this means is that we build our clients their own custom SmartMix and then directly invest in the underlying stocks for them in their own account. SmartMix is how we fulfill what is called a fiduciary obligation, which is a legal term for always putting our clients' best interests first. In plain English, fiduciary means treating our clients the way that we'd want to be treated. Here's how it works. SmartMix consists of our unique investment strategies. Each one of these is its own unique investment process, and we combine these strategies to create one unique SmartMix for each and every single client account that we manage, again, based on your personal situation, goals, objectives, risk tolerance, income needs, time horizon, types of accounts, amount that you've saved, and more. So what we're going to do here today now is we're going to go through each one of these, and we're going to look at how we customize the mix for each account that we are trusted with. So we're going to start with the wide moat strategy, and I may go a little bit more into detail on this one to help you better understand the rest of these strategies. With our wide moat strategy, the term wide moat figuratively refers to medieval castles. The wider the moat, the more protected the castle. So if you think of investing in the stock of a company today as being like a castle, what we want to look for are companies that figuratively have a wide economic moat around them, companies that have a long-term sustainable competitive advantage, companies in a good position to protect their ability to be and remain profitable. So that's what we look for here. And this is why our wide moat strategy is a great foundation for many of the accounts that we manage. See, there are more than 6,000 stocks that you can invest in just on the New York Stock Exchange and the NASDAQ. Now, some of these companies will be here and doing well 20 or more years from now, and some won't even exist anymore. So to find the companies inside these 6,000 that we want to invest in, we actually start with the work of Morningstar. Morningstar is the world's largest investment research firm for financial advisors. Currently, Morningstar has a team of over 100 analysts whose sole job is to rank stocks based on their moat. Some stocks have no moat. Some stocks have a medium-sized moat, and some stocks have a wide moat. At last count, these analysts, this team of 100 analysts, identified 311 stocks as having a wide moat, meaning they determined that these 311 stocks would have a sustainable competitive advantage for at least the next 20 years. Now, 311 is very filtered down from 6,000, of course, but it's still too many stocks to try to invest in. So the next step is to go through that list of 311 wide moat stocks and look for the ones that are less expensive than the others. If you've ever heard the term I want you to think buy low, sell high. That's the idea here. And as well as look for those that are gaining momentum in the markets. If you've ever heard the saying, a body in motion tends to stay in motion, well, the same can hold true for stocks. A stock in motion tends to stay in motion for a period of time. So after this rigorous filtering process is done, those 311 wide moat stocks are boiled down to just 25 individual stocks. And those 25 stocks are what make up our wide moat strategy. So as of yesterday, these are those 25 stocks that are in our CCG wide moat strategy. You probably recognize a lot of these individual holdings, companies like Disney, Google, Johnson & Johnson, 3M, Lockheed Martin, Gilead Sciences, Microsoft, Nike, ServiceNow, Pepsi, Eli Lilly, Schwab, Target, right? So these are the household names in America. These are the companies that have met that rigorous filtering process and should have a sustainable competitive advantage and that are priced low and gaining momentum in the market. Now, over the past 5 years, this is how these 25 individual stocks have done. And I'm going to compare it to the S&P 500. So there's a number of different things going on in this chart. The first thing is the dark blue or the lavender line there. That is the S&P 500 as represented by the Spider S&P 500 ETF. I'm going to point out something called a risk number. The risk number of the S&P 500 ETF there is a 74. The scale is 1 to 99. And then the turquoise line or that light green line on there as well, those are those 25 individual stocks over the last 5 years. And you can see that it does have a slightly higher risk number. And I'm going to go into more detail on what that is here in a few minutes, but it does have a slightly higher risk number. But what we can see is over the last 5 years, this rigorous filtering process has developed and generated an additional 50% return above and beyond the S&P 500 over the last 5 years. Now, if you watch it day to day, week to week, and even month to month, it can look like it's very similar to the S&P 500. The goal here is to slowly outperform and steadily plod and get that extra performance over long periods of time. But here, if we just look at the trailing 1 year time period, so this is August 1st of 2020 through August 1st of this year, 2021, we can see S&P 500 has done 35.4%, and these 25 stocks are up just shy of 41%. If we get in even a smaller time period, you can see year to date through August 1st, S&P 500 up 19.7, these wide moat, 25 wide moat stocks up 24.2. Looking on the risk side of things, so that was the return on the risk side of things, because there is risk with investing, right? On the risk side, again, that portfolio is a risk number, scores a risk risk score of 79. It does have a nice little dividend rate with it of 1.61. And one of the things that we really pride ourselves on is investing in individual stocks for individual clients, which means that there are no underlying hidden expenses like those that you can find with investing in mutual funds. The expense ratio inside of there is 0, nothing hidden. Okay, so again, that is our wide moat strategy. I'm not going to go into as much detail in the rest of the strategies, but I do want to give you a high level update on all of them here today. So the next strategy is our durable dividend strategy. The goal here with our durable dividend strategy is to invest in companies that have shown to, 1, sustain, and 2, grow their dividends over long periods of time, creating reliable income. So this strategy is a good fit for people in retirement who need to live on their life savings. So in this strategy, we own 25 individual stocks. And the goal is to, again, focus on how much income the portfolio is generating as the first priority, with the value of those underlying stocks as being secondary. So these are those 25 individual durable dividend stocks. And again, all of these companies have sustained their dividend over a long period of time, and they've even grown their dividend over time as well. If we look at these 25 relative to the S&P 500 again, we can see S&P 500 over the last 5 years, again, up 121.9%. The durable dividend stocks up slightly higher at 130.4%. And that does not include the dividend income that was generated all along the way. So what is that dividend? Well, a very nice, healthy dividend rate today of 2.4%. Similar risk number of 79 as the wide moat, but again, this one is creating a higher dividend rate for those of you that maybe are in retirement and need to live on what you've saved. All right, so that is the durable dividend strategy. The super dividend strategy is similar, but it places more emphasis on what the dividend yield or dividend rate is. So it's kind of like looking for just the biggest fruit on the tree. So fun fact for you, the biggest fruit in the world is actually the jackfruit. It's native to South India. It's part of the family of plants that also include fig, mulberry, and breadfruit. It can reach up to 80 pounds in weight. But again, the idea here is to just look for stocks that are paying an exceptional dividend rate and exceptional dividend yield. So these are the 30 stocks in this strategy that are paying an above average yield. You're going to recognize a lot of these stocks in here. You are going to see a little bit heavier weighting in energy, in financials, some real estate. But again, you're going to recognize a lot of those stocks. And so what we want to look for, again, is the dividend. So what is the dividend on these stocks? Well, as a whole, equally weighted, currently the dividend rate, the dividend yield is 6.23% on this portfolio of 30 stocks. So if you need income off of your savings, this is something that you might want to consider looking at. If that be the case, let's make sure that we have a conversation about how that could fit into your overall plan. All right, so that was the super dividend strategy. Next, we have our thematic strategy. In this strategy, our goal is to participate in the growth of disruptive technologies without the risk of individual stocks. So here's the opportunity. What this chart is showing you is how quickly new technologies are being adopted after they're first released. So if you look way over on the bottom left side of the chart there, you'll see back in the early 1900s, over 100 years ago, when the telephone came out, it reached a 40% adoption rate by the late 1920s. It actually fell during the Great Depression and then slowly climbed to its peak of roughly 96% during the 1980s. So the point is that it took decades and decades for the technology of the telephone to reach its full adoption rate. But if you fast forward to more recently, over towards the right side of your screen, the yellow, the orange, the red lines, these are the newer technologies. These are the technologies that have been disrupting their respective industries and being adopted very, very quickly. The adoption rate on things like cell phones, the internet, digital cameras, MP3 players, HD TV, social media, smartphones, tablets. The adoption rate of these technologies has been virtually straight up. Thematic investing gives us the opportunity to participate in the growth of these new technologies. But instead of investing in individual companies in these areas, because of investment developments, we can actually invest in the theme itself by using something called an exchange traded fund, or ETF, that represents a particular theme that we're interested in. So currently, these are those different themes that we're in. We're in a genomic revolution ETF that represents the genomic medicine industry. We're in an innovation ETF. We're in a European small cap companies. We're in an internet ETF. We're in cybersecurity. We're in lithium and battery technology. We're in this moonshot innovators ETF, and then we're also in an oil services theme, or oil services ETF as well. Now, some of these ETFs are newer, so it's harder to get long-term historical performance. And this is a newer strategy for us here. But here's the trailing 18-month chart of these 8 ETFs that we're in right now. So the S&P 500 over the last 18 months, up 38.8%. And the thematic funds up 89.5%. So just over the last 18 months, this strategy, these 8 ETFs have delivered an additional 51% just over the last 18 months. Now, if you notice something that has been kind of flat, kind of sideways maybe over the last 5 months or so, and I think Tom's going to talk more about that here in a little bit. But for those of you that are in this strategy, you probably seen that in your accounts. So this is January 1st through August 1st, just about year to date. Looking at S&P 500, again, up 19.7. These thematic funds trailing that up only 10.8%. Again, Tom's going to talk more about this moving forward, but if you notice, the last few days here have been just phenomenal in thematic, and we're expecting that trend to look good the rest of the year here. So again, Tom will talk more about that. Much higher risk number comes in at a 93, again, on that scale of 1 to 99. There is a small dividend rate of 0.74%. And again, these are all ETFs. They do come with an underlying expense ratio, but relative to mutual funds, very low at 0.51%. So again, that is our thematic strategy. Next is our pandemic recovery strategy. And this is kind of a unique strategy because it's timely, and it came as a result of a unique event, the COVID-19 pandemic. It's kind of like when you get injured. For those of you that follow me on social media, you know that my son Micah fell off his scooter a couple of weeks ago and broke his arm. And so since that time, we've had to do a number of things to try and help him heal. And it's like any injury, right? When you get hurt, there are different things that you can do to try to heal that injury and increase the likelihood that you're going to heal from that injury. So for Micah, he's got some pins in his arm. He's got a cast on his arm, right? He's taking it easy. He's not, doing a lot of activity, trying to get himself to heal. He's taking some medications, things like that. And again, we have full expectation that he will heal, but it's no guarantee that his arm will go back to the way that it was. So it's kind of like this strategy here, because the same thing can be said about the stock market. It's just that certain areas of the stock market have not recovered yet. So this strategy looks to those areas that have not recovered the way that other areas have. And the expectation is that these areas that have not yet recovered will. So here what you're looking at is the overall market as represented by the S&P 500. dating back to before the pandemic downturn in the spring of 2020. Now, many people believe that the entire market has recovered. And while it's true to say that the S&P 500 is higher than it was prior to the pandemic, it's not the whole truth. Here's a little bit more of the whole truth. If we dig a little bit deeper at all the different sectors or categories of the market during that same time period, you can see that some areas have recovered much better than others. So again, what we're doing with this strategy is looking for opportunities to participate in the recovery of certain stocks that have yet to do so. So these are the current holdings in the CCG recovery portfolio. Again, a lot of these you're going to recognize. You're going to see some travel companies in there, some real estate companies in there, some energy companies in there, all good quality companies. And we expect that they're going to recover. We expect that they're taking the steps necessary to get through this time period and come out ahead on the other end. Obviously, always there are no guarantees or no promises that they will, but that's the idea here with this strategy. Comes in at a risk number of a 93. There is a healthy dividend rate of 2.84% to get paid while we wait. But if we look at what has happened with these from January 1st through August of 2020 through August 1st of this year, so just over 18 months now, S&P 500 up 38.5%. These stocks are down 5.3%. Now, if we change the time period, though, we can see that things have shown improvement. And so what this is showing is November 1st of almost a year ago, 2020, through August of 1st of this year, 2021. See S&P 500 up 34.3% during that time, but these stocks are up 75%. And so that recovery, they've shown some recovery, and the hope and expectation is that that continues and we continue to close the gap that we see right here. All right, so that is the pandemic recovery strategy. The tactical ETF strategy is actually kind of a twofold strategy. I use a symbol of a swing here, and the idea is to help communicate that there are areas of the market that swing in and out of favor. And so, for instance, what we're looking at here on this chart is a time period of April of 2020, the lows of the pandemic, to the end of 2020. So the blue line is the overall market, the S&P 500. It gained about 30% during that time period. But the green line is just the growth stocks in the S&P 500. They were up over 35%. But the gold line are just the value type stocks, and they were up only 19%. So what we can see is that during that time period, the growth stocks far outperformed the value stocks. But if we change the time period to February of this year through June, we can see that the overall market, the S&P 500, the blue line is up about 8%. But the green line, those growth stocks, were only up 5.4%, whereas the gold line was up about just over 11%. Those are the value type stocks. So over those few months, value stocks outperformed growth type stocks, and it was by quite a bit. And then one more time from June 15th through yesterday, the overall market, the S&P 500, the blue line, up again about 5.4%. But the green line, those growth stocks, they were up over 9.7%. And the gold line, the value type stocks, they were up only 1%. So growth, again, outperformed value. And this is an ongoing situation where things swing in and out of favor. So what we just looked at is something that we call style. We can also look at the same thing as it pertains to different sectors. So here, what you're looking at are the different sectors over the past 14 years, ranked in order of how well they did. So if you look at 2020 at the top there, you can see INFT, the orange box there, that's information technology. That category was up 43.9%. Way at the bottom, the green box, energy, was down 33%, and every other category in between. But if you go back to 2018, you can see that information technology was not the winner, right? That was actually down 0.3%, and three other areas outperformed it. And so the idea is that, and what you can see is that different sectors are constantly jockeying for first place. And so they're going in and out of favor relative to one another. So that's the idea with this strategy, is that we're going to shift to those areas that we see coming into favor and out of those areas that are going out of favor. And so it can have some additional turnover. So we definitely want to talk more closely if we want to incorporate this into your strategy, because we can trigger taxes. So this would be a better strategy in many cases for a retirement account where we don't trigger taxes every time we trade. But right now, as of yesterday, on the style side, we're in growth. And then on the sector side, we're focused on communication services, energy, financials, consumer discretionary, and then we've got that core S&P 500 fund as well. Risk number on the style side did recently come down from an 86. It came down to 79. Nice little dividend rate there. On the sector side, still at an 86. Better dividend there at 1.74%. So again, up near S&P 500, a little bit over that on the sector side, even higher than the style side. So that was the tactical ETF portfolios. Lastly, for our equity portfolios, we have our aggressive portfolio. So this approach is kind of like a baseball player swinging for the fences. Tom likes to call it our Babe Ruth strategy. The idea here is that baseball player that comes out swinging for the fences may miss a lot of singles and doubles, but sometimes they connect and they hit it out of the ballpark. So in this strategy, we invest in individual stocks in themes that we feel are promising. Stocks we believe have the opportunity for explosive growth. So it's similar to the thematic strategy, but here we are taking on the risk of individual stocks. Now, this is a newer strategy for us starting in early of 2021. And these are the current holdings. Now, you've probably heard of ones like Airbnb and Fisker, the electric car manufacturer. I had someone ask me if that was the scissors company. No, it's the electric car manufacturer. Axogen is a developer of surgical solutions designed to remedy peripheral nerve damage. Churchill was a SPAC that acquired Lucid Motors. I do need to update this chart. For those of you in this strategy, you should have seen your ticker change to Lucid Motors recently. They're a luxury electric car manufacturer. Okta helps companies adopt technology. Cyclacel is a biotech firm developing cancer drugs and treatments. FaceDrive has ride-sharing roots, but has also gotten into food delivery, health tech services, as well as an e-commerce platform. Lemonade, not what you see my kids on the corner trying to sell. This Lemonade is an insurance company. They offer renters insurance, homeowners insurance, pet insurance, term life insurance in the US, and other insurances elsewhere. QuantumScape does research about solid state lithium metal batteries for electric cars. Bill Gates is an investor, Volkswagen is an investor, and then Trevena is a clinical stage biopharmaceutical company. So again, these are all stocks, all companies that we think have the potential to hit it out of the ballpark. Again, there are no promises, no guarantees, but our hope, our expectation is that over the next 3 to 5 years, each and every single one of these has the ability, the opportunity, and potentially could return 300 to 500% again over the next 3 to 5 years. So again, a very aggressive strategy. It moves up and down in large swings in short periods of time. It is not a good fit for many people. Those that do go into it, we usually put a relatively small portion into it. On a risk scale, it comes in at a 99. Looking at year to date, started out the year looking really, really good, shot up over 70%, has since come back down. We do have high expectations for it as we progress here into the fall, but again, it can swing in large amounts over short periods of time. So again, that was our aggressive portfolio. Again, some may hit it out of the ballpark, some may fail completely. Very, very aggressive portfolio. And then lastly, what I'll say with all of these strategies is that because we take full discretion over all of our clients' accounts, we do have the ability to go to cash. This is a chart showing some of those moves that we did during the year 2020, during the period of time during COVID, where we did step in. We did not stay invested. We got out of the market early on in COVID. We pulled money out of the market, went to cash, watched the market fall faster than it ever has, put some of that cash back in, slowly got back in over the summer, and today we still stay fully invested. So just a quick note on that. And then lastly, many people should never have all of their life savings in the stock market to begin with. So we have our fixed and alternative strategy to balance things out. Now, this strategy is for those accounts that we manage that should never be fully invested in the stock market to begin with. This strategy brings balance to an overall asset allocation plan and to an overall portfolio. So traditionally, as we age and get closer to when we need the money that we've saved, we would shift our investments out of the stock market and over to the bond market. But right now we're in an environment that creates some problems for owning bonds. Problem number one, rates are low. Bonds are not paying very much in the form of yield. Number two, the value of bonds have an inverse relationship to interest rates. When rates go up, the value of bonds go down. So interest rates are so low right now that they can really only go one way, and that is up. And when they do, this is going to put pressure on the value of bonds. So instead of owning bonds, we are 70% out of bonds and in non-traditional strategies. All of these strategies have the risk characteristics of the bond market, but they do not have the interest rate risk that bonds carry today. When we look at the risk metrics and expected fluctuations in value, see that risk number is only a 28, very, very similar to the overall bond market, which you can see at the bottom of the screen comes in at a 24. Over the last 5 years, the entire US aggregate bond market up 3.4%. These alternatives delivering a much healthier return at up positive 25%. Looking over the last 1 year, we can see the bond market is actually negative, down 0.8%, and this alternative mix delivering a 5.8% return over the last trailing 1 year period of time. If we take an even closer look from July 1st to March 1st, so July 1st of 2020 to March 1st of 2021, I wanted to show this because this was a time period when interest rates were rising. Okay, so since March of this year, they've come back down. So if you think that rates are set to start rising again, this chart may do a good job of setting expectations for the future. During that time period, the bond market was down 1.2% as rates were going up, while these alternatives delivered a 7.1% rate of return. So again, that was our fixed alternative strategy. Those are the strategies. We have accounts that we manage that consist of one of these strategies. We have accounts with several of these strategies. The thing that makes SmartMix smart is that we can custom mix these strategies unique for every single account that we're managing, because everyone is different. So no matter where you are on the risk spectrum, we can custom tailor a portfolio and a mix of strategies unique to you. So for all of you on the call today, whether you are an existing client or you're new here, ultimately the question is, what is your smart mix? It's custom and it's unique to you. There's an old way of doing things where we just said there are conservative, moderate, and aggressive investors. We don't believe in that. What we want to do is we want to dial in your risk tolerance to a specific number. We use a technology that was built on a Nobel Prize winning framework to specifically determine your risk number, and then we can build you a portfolio to match. So I'm going to get into that a little bit more at the end here, but ultimately the goal is to determine your risk number. It can be different for each account that you have. And once we do that, then we can determine your smart mix. So I'm going to turn it over to our Chief Investment Officer, Tom Fox. Tom is going to talk about our economic and market outlook, and then I'm going to come back on for just a couple minutes to talk about how to determine your smart mix. Tom has an incredible resume, over 30 years in the business. He was a pioneer in the development of tactical investment strategies. He presented proprietary research to the Federal Reserve Board's investment committee. I mean, just look at that resume. It is quite impressive. Tom is going to come on. He's going to talk about market positives. He's going to talk about the real headwinds that are out there right now. He's going to talk about potential headwinds that he's watching, as well as an outlook, and then we will take any questions. So on that note, if you do have any questions, feel free to go ahead and put them into the chat box. If you feel more comfortable, you can go ahead and send me an email with your questions as well. If you're watching this in the recording, please don't hesitate to send your questions to my email as well, and we'd love to circle back with you and get an answer to those questions for you. So with that, I'm going to turn it over to Tom. Tom, I think you're on. Can you hear me okay?
I can hear you. Can you hear me?
We can hear you great. Thank you.
All right. Thank you, Eric. Nice job on the Smart Mix delivery. That's fantastic. I'll tell you what, you do a great job doing that.
I appreciate that, Tom.
So we're going to talk about several things today. And I guess in summary, overall, we're still very bullish, and we'll talk about the reasons for that. Here's one of them is the market positives, and then we'll give our actual outlook going into the rest of this year and into the beginning of next year. So first of all, the corporate earnings, and earnings always drive prices in stocks. And we've seen spectacular earnings, both in the first quarter and blowout numbers in the second quarter. So if earnings, the reason, hey, why is the equity markets at record highs? In fact, we've just hit the 17th record this year, which we haven't seen since 1995. The reason is corporate earnings and revenues. And these numbers have come in way beyond what every analyst thought they would. Another very much a positive is that interest rates have come down. Everybody was looking for rates to go to 1.7 or 2%. We months ago said we thought it was more likely that they'd go to 1.2%. They did. They actually hit below that. Now they're in the little below 1.3. What does this mean? There's a downtrend in interest rates. Now we think that's going to change down the road. But what happens when there's low rates and bonds aren't delivering anything? That's why in our program that goes into fixed income and alternatives, we've been avoiding bonds and we are in other alternatives. And that's, I think Eric really explained that well. So we think rates could go up. They came down a little bit recently, but we think it's going to be short term. But when you have low rates, where do investors go? And what's happening? I was just listening to a big advisor on CNBC, and they said that they're forced to raise their clients' equity percentages. Well, what does that mean? That more and more money is going to stocks because of the problem in bonds. That's why we use alternatives today. And that's another approach to when you have rising interest rate potential. The Fed, there's a big meeting going on. It's virtual, but at the Fed is meeting what they call the Jackson Hole meeting, and they are planning to announce their tapering. Now we're going to find out the actual results this Friday when Chairman Powell will make his announcement and begin and give a speech on the direction of the Fed. But what's happening is that Delta variant is throwing a wrench in their plans to tighten earlier. And the first step they would do would be to pull back on their bond purchases, their treasury purchases, their mortgage purchases, because they're holding up that market, and then shift and go to less purchases. And then down the road, they would begin to perhaps raise interest rates. We think because of the Delta variant, which is impacting the economy, we'll see that in later slides, that they're going to have to be more dovish longer than expected because of this Delta variant. And you can see that in the consumer confidence and other things, which we'll look at in a few minutes. So another positive is household cash. Right now, the position of the household or the retail investor is fantastic shape. And because they didn't spend for a whole year because of the lockdowns, plus they've been saving. And we'll see a chart on that, but this could be a big tailwind in going forward in economic growth well into 22. So we think that's a positive. They're in fantastic shape. Also, the Delta variant, which has caused probably the Fed to pause. We're going to find out if I'm right on that Friday, but the Delta variant appears to be peaking, and especially in some of the hardest hit states. For example, Florida, we'll look at a chart like that. It does appear to be rolling over. When we look overseas, the Delta typically peaks about 40 to 45 days from when it started. And we're now in that 45 day period. So we may see this turning over. In fact, Dr. Fauci just said that he thinks that by spring of next year, it will be behind us. We'll find out. But right now, there does seem to be evidence that the Delta variant is slowing. And so another very positive is the FDA just gave full approval to Pfizer. Now, Pfizer was under emergency use only. And so a lot of people were hesitant to get it because it was under emergency use, but now it's been given the full approval, which I think will cause more people to get vaccinated. Several friends of mine that were unvaccinated just got vaccinated. So we'll see what happens. And we'll look at data and evidence that the unvaccinated are much higher risk of having severe illness than the vaccinated. And then the $1 trillion infrastructure bill will soon pass. The $3.5 trillion other, the family kind of infrastructure that the Democrats want to bring out, I think is going to have a hard time passing through the Senate. There's 2 or 3 senators that probably will not pass that. So we think the infrastructure, the main base, this is bridges, roads, things that we think of normal infrastructure will pass. But there's going to be, if there is an additional component to it, we don't think it's going to be anywhere near 3.5 trillion. Now, I've got 2 pages of headwinds, but the market always climbs the wall of worry. So we're going to look at these, and here are the realities. These are things that we're dealing with right now. The consumer confidence index just plunged, mainly because of the Delta variant. Also, the consumer confidence is down and other things. So people have gotten really nervous and they're pulling back on going on travel and some other things. And so right now that will have an impact on their spending, even though they're very flush with cash. It's going to pull back and cause some economic decline. And we already have started to see that. Also, we believe that here's another possibility: inflation will remain stubbornly high and moderately overshooting the Fed's relaxed target. And this causes the Fed to act on it. Now, we're going to find out Friday if they're going to act on it now or down the road, or kick the can down the road. We believe they're going to at least wait till their September meeting or beyond, but we'll find out. Another reality is that retail sales came in minus 0.4. It was expected to be a positive 0.2. So retail sales have started to pull back. This is all COVID variant related, the Delta variant. Also, China economic growth and demand has stalled. And of course, when they're the second largest economy, when you have the second largest economy stalling and slowing down, that impacts everything, US and other countries. And so that's another big reality that's going on today. And the other is that Asia and Europe are still dealing with COVID outbreaks. Even in China, there was an outbreak. Now they seem to have it contained, but it's breaking out again. Just some more numbers came out just today. So, and also the supply chain remains a problem. COVID overseas breakouts is not helping that supply chain. Many think we're going to have that supply chain problem for another year to 2 years. And we'll see and watch this very carefully. But these are what we're dealing with today. Now I'm going to look at what's potential. Here's the possibilities: that back to school, all the kids, all your children go back to school, and guess what? They start spreading COVID around, bring it home to the parents or the grandparents. So that is a possibility headwind. We're not saying it's going to happen. You remember back many months ago, I said that one of the headwinds potentially was that the Delta would spread throughout the US. That headwind possibility came to pass. Now, I don't like it when my potentials come to pass, but it happened. And so we were able to identify that early. It didn't impact the stock market other than a very short term because of the earnings have been so spectacular. Here's another possibility: the Fed tightens. Maybe even they announce that this Friday. We don't think so, but the Delta variant causes the economy to pull back even more than expected, and they tighten. So what happens when that happens? If inflation keeps rising, supply chain problems continue, the economy slows. What this is called stagflation. The economy will enter stagflation. We don't think that's going to happen, but that is a possibility, and that is not good for the stock market. The stock market doesn't, like in 2014, does not do well when you're in stagflation. And here's another potential negative: that the slowing demand from oil because of the slowdown in the economy because of the Delta, and commodities end up being permanent rather than transitory. We still don't think that's going to happen, but these are all kind of connected to each other. And they're really, a lot of it's around the Delta variant and what the future of that is. Okay, this is what our outlook is, despite all the positives and negatives and potential negatives. This is what we think is going to happen. Now, remember, we called months ago for by the end of July that the market, the S&P, would be around 4,400. Well, we hit that right on. The S&P went right up to 4,400, and then a few days later went over it. So we hit that target. Now we have another forecast, and that is the S&P by year end hits 4,700, and we're well on the way now. We're over 4,400, and the market's hitting record highs. I said earlier, we've had 17 new records this year, and we'll probably have more. So the S&P, we believe, will still reach 4,700. And you say, why was that going to happen? Because we believe that earnings will still be very good. And also we believe the economy, despite this little road bump with their Delta variant, will continue to grow. And especially it's going to grow more than other periods of time. And it still will be very robust, not as robust as we've seen recently, but we do think it's going to remain semi-robust. I'll use that phrase. Also, we believe inflation will remain sticky. This is because of the supply chain headwind. So that's going to be an issue. And again, that's the rock and the hard place for the Fed, because inflation will remain elevated. Hopefully it doesn't continue upward, but the economy be slowing down because of the Delta. So they have this war going on, and they don't want to get too aggressive because they don't want to kill this whole recovery. And so it's a tough place to be for the Fed. The wrench just was thrown into their program. So we'll see what happens. So we do think that thematic stocks are going to recover significantly from where they are. We've had now, today it's doing well. We've had 4 big days in the thematic stocks. In fact, they were several days, they were over 3 times the S&P 500 return. So it's coming off that poor performance recently. But I had originally forecasted that it would surpass the S&P 500. So I'm pulling back on that. I think it's going to recover from here, but it's still going to probably now underperform the S&P 500. We thought it would happen earlier, but we're pulling that back. So the economic growth slows somewhat, but we believe it will still deliver solid growth. And this, again, we've talked about this in our past conversations, but we're still very early in the recovery. Remember, recovery usually lasts 5 years. So we're still only a year and a half, 2 years into this, a year and a half, excuse me. So a little over a year and a half. So we still think there's a lot of time to go, and there's a lot of upside for equities. And we're not making a prediction in 22 yet, but as we get closer, we'll do that. All right, this is a chart that shows the earnings and revenue growth. And this is, if you look, 94% of the companies on the top line have reported, and earning beats. How many stocks beat their earnings analyst estimate? Almost 90%. This is incredibly high. So, they underestimated the first quarter. They were really wrong. All these analysts that get paid a lot of money were really wrong on this quarter. And the surprise was 18.1%. We're going to see how big that was. And for revenues, this is the top line. Hey, you can have earnings because cost cutting and other things, but what about the sales? Are they selling more? 87 beat their estimate, and the surprise was 5.8%. That was a new record too. And we'll see that in the next few charts. Now, this chart is showing the earnings blowout. You can see the first gray bar, which is the second quarter. You can see that estimate hit almost 90%. That's the highest we've ever seen. And then the estimate for the second and third quarter is it still beats, but not at the level the first and second quarter. We believe that we'll have a diminished beat, but it's still going to beat the next 2 quarters, which is really good for stocks. We do think we're running at the sort of the top end of where the S&P is going to go, but we still believe it will hit 4,700, and earnings are going to be the driver. This is revenues going back all the way to 2010. This is the revenue surprise. How much did it beat the analyst expectation? The far right bar is at a record. You can see the one before it was the first quarter, record revenue surprise at beating the estimates of analysts. And you can see that the other, this quarter was even much higher. That was historic. So revenue and earnings are driving this stock market higher. We think it's going to be more diminished, but still on the positive side, which should drive stocks higher by year end. All right, we talked about the financial health of retail investors or households, mainly because they stayed home and didn't spend money and they became savers. You can see when the 2008 the financial explosion happened because of the real estate overbuild, that people started reducing their household debt. We're at a low back into the 1990s, early 90s in terms of household debt. So the households not only have cash, but they've been reducing their debt. What that means, they have more power to go into stocks, more money to go in stocks. We think this is a very positive and a tailwind of the economic expansion going forward. They're going to be able to spend more. Now, the unemployment rate, this is kind of gives you a perspective on a long term. This goes all the way back to 1948. So this is a long-term chart. You can see where the unemployment rate has been. And you can see the first one bottomed in 2.5 in 1953. We bottomed in May of 1969 at 3.4. And then April of 2000, we hit a low of 3.8. This is a very robust employment. And then we went up again and we came down to 3.5. That was under Donald Trump's economic programs. And then the COVID hit and it went to a record high. But now we're at 5.4%. You can see it's coming down. It went up straight. Now it's coming down straight. This is record declines and record increases that we've never seen that in unemployment, because this was a biological issue that we're dealing with. And the economy was very strong when the COVID hit, and which helped sustain the situation. But what is the Fed's target? They want 3% or something close to 3% in unemployment rate. What does that mean? That puts pressure on them to continue to be dovish, continue to buy bonds, treasuries and mortgages, and continue to keep rates low. So we think that they haven't come near their target. They talk a lot about that. We'll probably hear more about it on Friday and see what direction they're going to take right now. Okay, we've talked about earlier supply chain disruptions. And so when the second quarter, all the CEOs and so on, financial CFOs got online about their earnings for the quarter, this is how many times they talked about supply chain problems. And you can see it was bad last time, and it's even worse this quarter. Hit a record high. The average is around 186. Well, they went over close to 900 mentions about supply chain. So this is going to be a problem. It's still a problem. The CEOs and the people that run these companies have been talking about it more than ever. So we think it will continue. Now, we've talked about also consumer confidence, and this has pulled back some of the travel, some of the people spending money. They have a lot of money, but they're slowing down in what they're doing. Why? Because their consumer confidence index. The main issue, what's driving this down, is COVID variant. Since April, you can see how it's fallen. We think it's going to stabilize, but when consumers are not confident, they do not spend. So we do believe this is going to have an impact on the economy, slowing it somewhat. We still think it will be robust based on historical perspective, but this is going to have an impact on the economy. And I already know some people that are canceling their vacation trips and so on because they're afraid of the Delta variant. All right, let's talk about the Delta. Let's talk about the COVID overall, especially in the hardest hit states. We'll see that. And this is the overall COVID new cases. But look at the blue line, which is the 7-day average. You can see that it's starting to come down. So we believe it kind of peaked on 8.6, and it's now beginning to kind of go in a different direction, maybe peaked in 821, 88, but it's coming down over this last month, and it even went negative this last reading. Now, this is too early to say that the Delta is really turning over. We think it is, but it's showing some of the signs when you look at the data. Now, this is Florida, which is one of the hardest hit by COVID, new cases, hospitalizations, everything. Florida was just hit very hard. And here are some of the counties, the largest counties. You can see it's rolling over. So the new cases have really rolled over, and some cases even gone negative. So this is a great sign. And this is similar to what we saw in Israel, in the UK, and some other places that were ahead of us in the Delta. They got it first. So this is good news. Hopefully the Delta is peaked and coming down from here. Now, another bit of good news is the number of people getting vaccinations. You can see this is July to current, and it's going up. I know, again, I said I know friends that were not going to get vaccinated. Now they're going to get vaccinated, and the FDA approval of Pfizer, a full approval, should make a difference in keeping that line and going up. And so the numbers are going up in vaccination, and we're going to see some charts in the next minute here that show that the difference between vaccinated and unvaccinated. And maybe you're unvaccinated, that's a personal decision, but you got to look at these charts. This is Israel, which were highly vaccinated, and the active patients and age group and their vax status. So you can see the vaccinated versus the unvaccinated were far worse than the unvaccinated. But look at the chart to the right. This is severe illness. Unvaccinated, the number in Israel that are unvaccinated are much higher than partially vaccinated. And you can see the dark blue line at the bottom, that's fully vaccinated people that end up with severe illness. And you have a less than a 1% chance of dying if you've been fully vaccinated. So there is a definite statistical analysis and data you can look at that really shows the major difference of getting severely sick or even dying unvaccinated to vaccinated. Israel is an example of that. Now, hospitalizations and deaths, this is still going up. And the reason is, even though that Delta's rolling over, appears to be, this is lagging. The hospitalization and deaths will lag. So in other words, you have to see the new cases go down, and then deaths will roll over, then hospitalizations will roll over. You can see we hit another peak here, second biggest peak. We haven't hit the big peak. Notice that mortality or deaths is lower than maybe 3 other periods versus the hospitalizations, because we're getting better at dealing with COVID in the hospitals. It's not their first rodeo, so they're actually getting better at saving lives. There's some drugs like Regeneron, we own Regeneron, they're really helping keep them alive. Okay, so is it having an effect on the economy? Well, if you look at dining out, you can see it peaked. The left chart, the red line, is the diner and the airport passengers going through TSA. You can see both of them have rolled over. Not a lot, but it is turning downward. And you can see month change in retail sales in many of the sectors have begun to come down, month over month percent change. In fact, overall retail sales are down -1.1. So we're starting to see some pullback in the economy. And these two charts show that the Delta variant is having some impact. Another one is the TSA. You can see in the left chart how it went up to its peak in 2021, just touched. A lot of people started traveling again. And you can see it started in February, that people started traveling more, but then look at it's rolling over a little bit. So we'll see where this goes. It all depends on the Delta variant, but it is having some impact on people, whether they're dining out or whether they're traveling. And so you can see this now ending up in the stock prices because industry performers, hotels, restaurants, and leisures has rolled over. Aerospace, which it builds planes, has rolled over somewhat. And then airlines has really rolled over. And this all has to do with these numbers potentially rolling over. Most likely they'll be oversold and there'll be buying opportunities in these sectors. So the COVID variant is having an effect. This is my third chart. This is Goldman Sachs, their economic estimate by their investment research group. They're normally very good on where things are going in GDP growth. But you can see this, the red star is what their previous forecast was. And you can see in the far left bar, they thought the third quarter would end up being 9%. They have lowered that to 5.5. So that is, and you can see the consensus is the light blue. This is where all the economists think, but Goldman Sachs was expecting 9% for the third quarter in GDP growth. They have significantly lowered that. However, in the fourth quarter of this year and first, second, and third, and fourth, they've actually raised their outlook. So the full year, they've lowered it in the whole year slightly. And then you can see the 22 that they're expecting to be about the same. But the pickup, the big quarter that will be hit because the Delta COVID variant is the third quarter. And we're in agreement with this, but we think that there'll be a jump in the fourth quarter. And so that's where we get that 4,700 target. It may be bumpy. I've told you before, we're going to be on a bumpy ride, but we think it's going to be still a good year if you can hang in there. All right, so now I'm going to talk just about each portfolio. The wide Moat has been doing very well. In fact, it jumped ahead of the S&P just recently. Kind of been flip-flopping right close to it, but now it's ahead. Thematic has underperformed since mid-February. We still think we're hopeful that the high growth segment is going to pick up. Remember, this was up over 60% last year in 2020. We think we're going to have a big recovery in it. I'm still thinking it may end up under the S&P by the year end. Before I had thought it would outperform. Now I've pulled that back. But we think it's a great time to get in Thematic or be in Thematic. Durable Dividend, which kind of had a slow first half, that's picking up, doing very well in the second half. Aggressive Babe Ruth portfolio, that's a more concentrated thematic growth, so it's very similar to it. And we're expecting the same thing for Thematic, that it will end up doing very well. It's still going to be under the S&P for the year, but we think next year probably the biggest performer will be the Babe Ruth portfolio. Now, fixed alt, we remain structured for rising rates. Again, we're outperforming the Barclays Aggregate Bond Index. We're actually going to probably make 2 to 3 trades coming in here. We're going to go to some futures managers, and because there's some good ones out there that I'm going to probably pick up. And we're still not wanting to get in bonds. Now, if we thought it was a good time to get back in bonds, we will. If rates rise and they get to the point where we think it makes sense to get back in bonds, we will begin to move the portfolio out of alternatives into the fixed income area. Many, many months ago, we moved out of the fixed to the alts, and you can see that in the performance that Eric was showing you. So we're hoping for about a 3% year-end return. We'll see how that comes in. It's been a very tough period to make money in anything other than stocks this year, but we're certainly doing much better than the fixed income areas. So the pandemic recovery has been outperforming. It's been stalling recently. It's been picked up today, the last few days, and eventually the pandemic recovery will be complete. And so what this recovery portfolio will do is we're going to shift it to Warren Buffett stocks that have been underperforming. They have the characteristics that make them leaders to their peers, but for whatever reason, their stocks underperform. So we're going to own eventually a basket of stocks down the road. Once we sense that the pandemic recovery stocks are complete, then we're going to rotate to a different kind of recovery. And I'm excited about this one, Warren Buffett stocks that have been beat up. So we're going to have that portfolio transition to that. Super dividend, seeking over 5% or around 5%. That remains, the returns are stable. They're doing well the last 4 days, especially. So you're getting such a high yield. And I think it's up to what, Eric's over 6% now, the yield on that. And then tactical style, we've been in growth. And then in the sector, we're kind of offsetting that because there's been a lot of flip-flopping. We're kind of more to the economic sensitive. So we're kind of have a barbell approach between the style and the sector.
All right. Well, Tom, as always, thank you very much for your objective and educational information. You're so good at cutting through all the emotion that's out there on the 24/7 news cycle and social media and everything. Just really appreciate you and all the work that you've put into getting us this update here today. So as a reminder for everybody in the call, if you do have any questions, please go ahead and put them into the chat box. We'd love to get those to Tom or myself here today. And again, if you're more comfortable, don't hesitate to shoot us an email. Love to circle back with you. Or as always, you can go to the website and schedule some time to connect as well. Lastly, we're a few minutes over the top of the hour here, so I will kind of move us along here somewhat quickly. But ultimately, what we want to do is we want to build you your smart mix. And so if you are an existing client in SmartMix and you have questions about what your mix is, how it's doing, if it's the right mix, if adjustments need to be made, if you just need to do a review and just better understand what's happening, please call the office, schedule some time with Marilyn. She'll get you on my calendar, or you can go to the website anytime. My calendar is on there as well, if that's easier for you. But ultimately, we want to determine your smart mix. For those of you that are new here and you'd like to see what a smart mix portfolio might look for you, quick invitation, go on over to getinvestedright.com, short questionnaire there, and you can fill out a request and we will be in touch with you to talk about what smart mix would make sense for you as well. And then lastly, a couple of things real quick here. Every Monday, I do a market update, trying to cut through, not as nearly as detailed as Tom does, because he does such a spectacular job, but short 3 to 5 minutes, update on what happened in the markets. Sometimes I'll do updates on SmartMix, sometimes I'll give little nuggets, but it's just a quick, short check-in on a weekly basis. Again, that's every Monday. You can join me live on Facebook, live on YouTube. You can watch the recording on our website later. If you'd like to subscribe so that you get an email when that recording comes out, go to our website, investwithccg.com/WEVU. That's weekly economic video update. And you can enter your email in there and I'll send you 1 email a week with that link. And then a little bit of fun. Let me just check the chat box. So we do not have any questions in yet. So final chance here, everybody. One last little bit of fun here for you. We do have a client appreciation event coming up here. If you have not already, please go RSVP for our next event. It's called Sippin' and Dippin' with Tony Porcellini. For those of you that attended our wine tasting event with Tony, the wine guy, this past December, Tony is back to share with us some staples of the Southwest. So he's going to be making margaritas, some guacamole. So go to the website, investwithccg.com/events. Would love to see you on that coming up here in just a few weeks. So last opportunity, if you have any questions, go ahead and put them in right now. Going once, going twice. All right. Well, again, thank you all so very much for joining us today. Again, if you're watching the recording, you have questions you want to follow up, please don't hesitate. We'd love to circle back with you, answer any questions. One of our goals here is to be as transparent with you as possible about what we are doing with the life savings that you have entrusted us with. So with that, Tom, thank you again so much for being on the call today and for all of the wisdom that you shared with us. It is so wonderful to be able to, again, cut through all of the emotion that is on TV and on the internet here today. So thank you. Hope you have a wonderful rest of your day. And for everybody else, hope you also have a wonderful rest of the day. And if you're with me and Tom here in Minnesota, enjoy the beautiful weather because it's a good one today. So
Thank you, Eric.
yeah, thanks, Tom.
Thank you, everybody.